Hello, and happy summer from your friends here at the Financial Advisor Group. We're heading into the tail end of July and about to kick into August, which I know we say it all the time. It's just hard to believe where the time goes. Just wanted to reach out and give a little bit of an update on our view on things economically and as the markets go. Nothing too dramatic. Our overall view is that things continue to be okay, that people are spending money. And to oversimplify this thing, if people in this country have jobs and have income, we're good at spending money. And if that continues, we think this economy can continue to be okay. And okay is okay. Uh, Into a little bit more detail, just three topics we'll touch on a little bit today. One, we have an Olympic sports theme that we'll touch on. Second, we'll talk about pullbacks, right? And sort of a necessary evil of the markets. And last but not least, of course, if you haven't heard, this is an election year. And every election year, it comes to what impact will that have on the market? You probably know our answer already, but I'll make you stay on and listen just to hear in case it changed this time. So as we jump into this, one thing that's interesting to us, we titled this presentation Federer versus the Markets. Roger Federer, for those of you that don't know, is one of the best tennis players ever, not just of our generation right now, but one of the best tennis players ever. He recently had retired, and he actually gave an excellent speech at the University of Dartmouth earlier this year and had some pretty amazing statistics that he quoted during his speech. At his commencement speech, he quoted that in tennis, perfection is impossible. In the 1,526 singles matches he played in his career, he won almost 80% of those matches, which I think we'd all agree is pretty darn impressive. Now, here's the question. What percentage of the points in those matches do you think that he won, right? Won 80% of the matches. So you would think he won a pretty high percentage of the points. When you look in depth, he actually only won 54% of all points that he played. In his words, even top-ranked tennis players win barely more than half of the points that they play. When you lose every second point on average, you learn not to dwell on every shot. You teach yourself to think, okay, I double faulted. It's only a point. Okay, I came to the net and I got passed again. It's only a point. Consistency is what got Roger Federer to be not just one of the greatest, but possibly the greatest tennis player ever. We'll tie this into the markets in a minute, but I think that's mind-boggling. That one of the greatest tennis players of all time only won 54% of the points that he played, which then equated to winning 80% of all the matches that he played. How does that tie into the markets? Well, Roger, appreciate the coincidence here that did you know that the market, the S&P 500, is up on only 52.4% of days. That's it, right? Similar to Roger Federer, he's only winning the points about half the time. The market's only up about a little bit over 50% of the days in the market. But consistency matters. Just like Roger Federer's success came from not getting caught up in losing a point or not getting caught up in this scenario in a down week or a down month, it's being consistent and having that consistent game plan is what brought Federer success. And we think that's what brings investors success as well. And again, to tie into the Roger Federer theme, yes, the market on average goes up about 52.4% of days. And on the average up day is up 0.75%. On the average down day is down about 0.75%. But did you know over time, similar to the Roger Federer story, this chart here will show us over time how often the market is positive. So over a daily period, we just talked about, it's about 54%. If you go out to 1 year, almost 80% of the time the market is positive, very similar to Roger Federer. In our view with our clients, we're hopefully looking out well beyond a year, whether that's 3 years, 5 years, 10 years, 20 years. Where else can you only win 54% of the time, but on a 5-year basis, you win 93% if you stay consistent? Again, we just want to hammer this home that this is consistency matters. So yes, we will have down days. Yes, we will have down weeks. Yes, Roger Federer double faulted, but he kept doing the same thing, and that's what brought him success. We know tough times will come, but just like Federer, we want to forget about that and know if we stick with our consistent pattern that we'll be okay. As you see at the bottom of this chart, if the stock market is a casino that sometimes people compare it to, it's the only casino in the world, think about this, where your odds of success increase the longer you play the game, right? Most casinos, the longer you stay inside the building, the more money you're losing. Your odds get worse. With the market, the longer you stay in, your success rate actually goes up. So one of our main tasks is keeping you invested through all the hoopla, right? That leads us into our next discussion point. Well, what about corrections? Pullbacks and corrections are normal, right? This is just a normal part of the investing world is having, in fact, we call them healthy. Did you know that there has been a drawdown or a fall of 10% or worse in 65% of all years since 1928? So going back about 100 years. Corrections of 5% or worse occur almost every single year. So it's actually more surprising if you don't have a 5 or 10% correction than if you do. So this goes back with Roger Federer, again, to keep that analogy going. Of course, he's going to double fall, right? It's just going to happen. So it's more surprising to us if the market doesn't have these 5 and 10% corrections than if it does. We just need to know to expect them, and that's normal and that's natural. Where does that lead us today, right? If you look at historically, the market falls 3% about 7 times a year, right? This tells us how often these types of declines happen. We've only really had 1 or 2 of these so far this year in 2024, so let's keep that in mind. Normally, the market falls about 5%, about 3 to 4 times a year. Again, we've only had 1 of these so far this year. A 10% correction happens about once a year on average. We haven't had one yet. And then the more severe corrections, as you can see here, don't happen as often. 15% about every other year. And those bear markets that we talk about and get so focused on happen about once every 3 to 4 years, if you look at it. So what this tells us is, one, volatility is we have to accept that volatility to get that success. We have to accept a double fault every once in a while to get that 80 to 90% win rate. One thing we were happy with it, and this sounds strange, is last week we had the first 2% fall in the market in over 356 days. This chart, there's a lot going on here in this chart, but what you see, it charts how long the market has gone before without a 2% fall. And if you look historically, we typically go about 100 days or so between a 2% drop in the market. We just went through a time period where we tripled that. We went 356 days without a 2% correction or fall in the market in one day. We had one last week. That makes us breathe easier because we know these corrections are going to come. Let's let them come and just understand that that's part of the market, right? That's what our job is in planning, is to know they're going to come and have a plan for them. So on the volatility front, right, to tie it back into Roger Federer, we know we're going to have double faults. We can't avoid that. But if we can consistently stick to our game plan, we don't have to get as worried about those double faults because we know better points are coming as long as we stick to the script. Last but not least, election year is here. I think that the headline of this slide says everything. And you'll probably, if you're hopefully you're with us another 4 years from now, we'll have the same repetitive answer that just don't mix politics and investing. I've been doing this. This is my 25th year here with the firm, which is sort of mind-blowing to me. But this will be my 6th or 7th election cycle that I'm going through. And we've had the same message every time. And every time it's proven to be right, that politics and investing don't mix. Now, the parties will tell you they do, right? Each party will tell you if they win, it'll be better. If the other one wins, it'll be worse. But big picture, the market truthfully doesn't care. Right? What this goes back and shows us is each of their terms is represented as a bar of how the market did since Teddy Roosevelt, going back of how the market did during their term. The red bars are the Republican candidates. The blue are the Democrats. What the bar shows you is how much the market went up or down during their presidency. Also, the black dot shows you how much the market fell from top to bottom at some point during their presidency. I'll pick out Barack Obama. Right during Barack Obama's presidency, we had a 19% rate of return. But at some point during that time period, the market fell 23%. So what we show here is during every presidency, for the most part, markets go up, but they also have down periods. Both things happen. No matter if it's a Republican or Democrat, markets do what markets do. So we don't want to get too caught up in who's in the White House. This chart, which I think we showed earlier this year, This chart goes back again about 100 years and shows us that what has the market done during whether it's red or blue? It's gone up. Let's not get too caught up in if this is going to be a red bar chart next or a blue bar chart next. Let's focus more on, is Microsoft doing a good job running their company? Is NVIDIA innovating and changing the world around us? That's what drives the market, not who's in the White House. I think that's so important to understand. The last slide we'll end with here is one of my favorites, right? And I think during election years, we tend, and recently, right, we tend to try to look at, well, what if this happens? What if that happens? This chart here down below doesn't just go back 100 years. It's from Morgan Housel, a great economic mind. And he shows the chart of the S&P 500 over the last basically 150 years. And what has it done? For the most part, it goes up. Just like Federer, for the most part, he's winning. During any time period over this last 150 years, you could make the argument that the future looked dim, the young generation was lazy, and politicians were screwing everything up. We tend to hear all three of these things today, right? But I think we always have that mindset, but we think it's important to believe in the American economy and believe in American corporations, and that's what brings the success. So to sum it up, really, we want to be your Roger Federer, right? We want to be consistent. We want to be able to, yes, we won't win 80% of the days, but if we can consistently win 54, 53% of the days, then we know long-term we're going to have success. We don't want to get caught up in trying to get it right every single day because we know that won't work. But if we can consistently have a game plan, just like Roger Federer, we hope that will bring us success. That might be the first time I've ever tried to compare myself to Roger Federer, and probably the last time. So thank you as always. We really hope you continue to trust and have confidence in us, especially during years like this, election years, which just tend to get loud and noisy. Let us be the ones who focus on this and take care of the accounts. And your task, enjoy life. Enjoy the time with your family, your friends, and hopefully this summer you've been able to do some traveling. We look forward to seeing you or talking with you again sometime soon, and do your best to make it a great rest of the summer. Thank you as always.